Today is April 25, 1:13 p.m. We detected unusual options activity on Blackstone, ticker symbol BX. And so in this video, we are first going to identify these unusual options. And then second, we're going to analyze these unusual options to find out what these large institutions are doing. And third, we're going to use the results of the analysis and show you how we set up a trade based on these unusual options. Before we get right to it, wanted to point out that in the news media, just yesterday, April 24, you'll see these Blackstone unusual options activity. And actually, what it was saying was that it was noticeably bullish because there was 75% bullish expectations and 25% bearish. So you would think then that it would be bullish. However, when we actually look at these unusual options, we're seeing something different. We saw that on 11:42, May 19th, the 83 strike puts, 7,875. Also here, same strike, same date, but a different time. However, this one was actually done together with the April 28, 88 strike puts. You'll see that. So that's interesting because that was 4,200 of them. What we think this one is quite an interesting, unusual trade because that actually expires in 3 days. So what we believe is happening is at the 80 strike puts, they're actually closing their orders here. You'll see here the volume here is 7,100 and the open interest is 7,200. So it's less. So they could be closing these orders, selling their 88 strike puts, taking profits because they're in the money now at $86. And by taking those profits and then rolling it out to May 19 and then buying these 80 strike puts, you'll see there's also these 82 strike puts here too, both of which have much greater volume than the open interest you see here. So these are all open orders. So as you'll see here, lots of these 80 strike puts were also being done throughout the day. So based on this, we are actually bearish. And so to trade with this, what we are going to be doing is slightly different than these unusual options. So they are essentially buying the 83 strikes. And you'll see here that when you analyze this trade, it actually has quite a negative theta here at negative 6.8. And so at expiration date, if it doesn't drop below 81 here at the break even, then they will be at a loss because this is below the zero profit loss diagram. And so what we are doing instead is slightly different because this is close to a support level here. Because this was a recent level here, this price range, and you see here lots of activity here that just in case this is actually this resistance and support level does hold up and it does bounce, we are instead going to go with a diagonal bearish trade. So instead of buying that, we're going to sell the 83 strikes. And then for the June 16, where the volatility is less, we're going to buy the 85 strikes here. You'll see over here is our position. You'll see here that current volatility is at 40%. And so this is our trade here. And if we analyze this, you'll see that this is what our trade looks like. It is also bearish as the price drops. It will also be profitable. And so if it does make that 83 price range here, we will be at near our max profit here. This is our max profit here. And so at any time throughout, as long as this trade stays below our break even, which is actually higher than where it is right now, it can actually come up to 88.96 and we will still not be at a loss at expiration. And so this is why we like this trade. 88.96 is basically $89. So $89 is up here. So this can rally back up due to it being oversold for the past 4 days. It could still come up, and as long as it comes back down, we are still going to be profitable. And so that's why we like this trade. It allows us to have some room towards the upside here. And in case it does crash very much down, our loss is pretty much capped. You'll see it's very minimal loss here if it drops. It's actually not 21 because when we put on this trade, we got a better price actually because we did this trade a little earlier. But right now it's the value is more, and so you have to pay more now for it. But we paid less, so it's actually already profitable. That's why for our trade, because we got it for $2, so it's actually less for our trade when we did it. The reason why this is such it has such a nice upside here is also because we have a positive theta, such a high theta here, and we are going quite. We're buying the 85 strikes, and because of the volatility is also there's a big difference, much more than other trades. Is you'll see here, as I mentioned, 40% here. And so this trade on the sell side is actually 42. So we're actually selling higher volatility and buying lower volatility. So we're taking advantage of that. That's always good to sell when it's higher and to buy when it's lower. And so we're taking advantage of the differences in these dates to create that volatility difference to take advantage of that. And so that is pretty much what we think, and we will cut our losses if it does rally past that 89, and we will have room to cut our losses if it does bounce and the media was correct. We will have time. If it was not correct, then as it drops, we will be profitable, and as long as it stays above the as long as by expiration it stays above $70, this trade will be profitable. And so $70 is actually quite far down, all the way down here. So we have a lot of room to drop. It's pretty much lower than where it was just the yearly lows back in last year in December here. You'll see it only made a low of 71. So to go down to 70 is just less likely to happen. So this could drop anywhere here, just stay in this whole range here, and it just be profitable for our trade. So this is why we like this trade, and we have this positive theta. And so if this was helpful and you learned something, please smash that like button, subscribe if you haven't, and hit the bell icon, and you'll be notified whenever we see unusual options. Take care, everybody, and good luck.